the Fed clearly is of the view that inflation pressures are going to be persistent, and that they Fed have a different perspective in terms of what that inflation trajectory looks like over the remainder of this year. If growth remains as strong as we're currently seeing, and inflation pressures remain as firm as we're currently seeing, then the market is not going to be right in pricing that easing by the end of the year and those substantial cuts we see in 2024. However, Chairman Powell also did acknowledge that the disinflation process has begun. The market has, or certainly the consensus forecast, recessionary conditions around the middle to the end of this year. And if actually the inflation swap market is right, which projects actually inflation down towards 2 towards the end of this year, you could see the conditions that the Fed may be able to start to provide some interest rate relief around the turn of the year. So I think it's really crucial, how that inflation trajectory evolves over the second half of this year will be key in determining how government bonds perform in 2023.
Well, Roger, let's just have a look at the 2-year. And just today, we hit 4.37 at one point. We're right back up now at 4.47. Is that a fair price for the 2-year yield?
We think the market is reasonably fairly priced here. We've been trading the market general from a short duration stance in the front end over recent months. We thought the market levels looked just too low relative to the policy guidance that the FOMC has been putting forwards, and obviously the extremely strong data we got on Friday, the non-farm payrolls numbers, and also importantly the re-acceleration we saw in the services ISM suggests that the Fed will be able to deliver on its dots, and indeed Chairman Powell today reiterated some upside risks to the dots if the labour market remains as firm as it is. So, that repricing in 2-year yields down from the close to 4% we saw only a few days ago, we think is quite fair. There is still the potential that 2-year yields could rise a little further if we move to price out those cuts we still see towards the back end of the year. But a substantial further rise in 2-year yields from here, I think, would require the market to gain a lot of confidence that growth can be stronger in the medium term, and that those substantial 200 bips or so cuts we have between the middle of 23 and the middle of 25 are unnecessary. That I think is the key to bond market pricing.